Hi, and welcome back to Auction Market Theory 101 in this order flow mastery course. And we will lay down in this video and the next few ones the basics of understanding of the liquidity auction theory model, which is the ultimately realistic model to analyze market structure based on facts, based on data, based on reality, that deletes all the fluff, all the I think, all the my opinion is, and most of the stuff that you normally are fed in social medias. And we start from this model, okay? Which is a very simple model. Consolidation, balance, fair value, imbalance, no fair value, search for liquidity, price discovery, and then again, balance. Okay? These are the main phases of the auction market theory model. Why does this happen? Well, let's imagine that, as we know, let's say we start from here. We have all of these passive sellers, all of these passive buyers, and there's sellers aggressing the bid, buyers accepting and lifting the ask. And the double auction keeps moving price up and down, up and down. And throughout all of this phase of the market, all four of our forces, passive buyers, passive sellers, aggressive buyers, aggressive sellers, are in a situation of balance where you'll typically see from the volume profile a situation of fair value and a lot of money being traded throughout all the range. And this is a situation where both forces are agreeing that this is a fair price to trade. That's what we have to understand from this. Because as we know, markets move because of the variation in the perceived value of the underlying asset. So whenever we think that, both sellers and buyers, aggressive and passive, think that this range of price is fair, it's a fair valuation, where it's fair to trade, where it's fair to sell and to buy, both aggressively and passively, in a way that makes price action balanced, that will keep the price around the same range. Because of the trading activity that happens behind, makes us understand that that's a fair price for the market. That whenever we try to auction in the higher prices, there's more of a bias to sell. And whenever we move to the lower ranges of the range, there's more of a bias to buy. So a situation of balance is the ultimate description of a fair valuation. That's why we call this the fair value area. But something happens. Something might happen. A news might come out, as we remember the example with Apple. Well, when Apple releases its earnings and it's way higher than expected and they're making a lot of money, well, the perceived valuation of the Apple stock will rise. So if before buyers and sellers were agreeing that this was a fair price to trade, well, sellers might not agree anymore that this is a fair price to trade. Aggressive buyers instead, and all sorts of buyers, will agree that this is a fair price to buy, this is a fair price to buy, this one is as well, this one is as well, and all of these ones are fair prices to buy. And to aggressively accept paying slightly higher prices as long as they can get their hands on the underlying asset. And this shift in the auction typically happens either because, in the most stupid example, something happened, a news came out, or because the net pressure of long-term market participants, taking into consideration the fundamental value, so this fundamental bias is long, and most institutional traders will typically split their orders, right? They will not put their order in the market all at once, but they will fraction it, okay? And they will fraction it in order to not have this impact on price, so that they can get a better fill, right? Because if they were to buy all of these orders all at once, what will happen? They will buy some here, 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 and their average price would be here, for example. But if they buy just a little bit, wait till more aggressive passive sellers come, and then buy a little bit more, and then buy a little bit more, where now their fill is here instead of being up here. So for an optimal execution of these huge orders that big banks, hedge funds, and all of the smart money market participants have to go through, in order to get a better feel of this mass of orders, they will typically fraction their orders, right? And a lot of the order flow you're going to see comes from this perfectly cadenced rhythm of fractional institutional orders, right? And at some point, one of the two flows might outflow the opposition, okay? So in the most stupid example, this happens because of a change in the fundamental perception, but it also could be a continuation of the current perception. Because maybe they just need to pour more money in the market to fill all of their positions, so the auction just goes higher, right? And if I had to ask you a question, right? These buyers that are buying and paying a spread, do they like paying a spread and constantly get filled at worse and worse prices? Do they like it? Not really. What would be the ideal scenario for them? That a huge seller in the book was here, they would buy into it, he would absorb all of them so they can get a good fill because they think price will go up anyways, so they get a better fill. But sellers are not present. Not as much. The book is thinner on the sell side. So what they're actually doing when they're pushing price up, because of this aggression, is intrinsically looking for liquidity. Looking for counterpart. Looking for an easier way to trade that, they don't get filled at worse and worse prices. They're looking for sellers that consider these prices fair. And they might not find it for a long time. But at some point they will, because prices will rise. And now also the sellers will start seeing this level of price as a fair price to trade, as a fair price to sell. So we will find ourselves again in a situation of balance, where both forces, aggressive buyers, aggressive sellers, passive buyers, passive sellers, agree that this is a decent price to trade. And that's where you see a lot of volume going on. Again, a lot of trading activity. This is where smart money prefer to trade because there's a lot of liquidity, there's not a lot of price movement, they can get their fill very optimally. And that's where the auction clearly tells us something that price action is explaining as a consequence of volume. That the market from both sides is accepting that this is the new fair valuation, that this is the new fair price. Before, this was the fair price. Now this is the fair price. So the auction is likely to keep bringing price up. Okay? This is when a trend is qualified. So not just this, with highs and lows and highs and lows. We want to see this. Market agreeing that that's a fair price on both sides. Not for a small price swing, for a long time. We need proof that all the institutional order flow is on our side. And this is the basics of the auction market theory model. So you got a balanced market, a fair value area, an imbalanced market, and then again a balanced market. Let's get deeper. It's not just going to go like this, okay? It's likely going to go like this, right? And the next level into framing this in a way that is more realistic is introducing failed auctions, okay? And by failed auction, we mean one of the two parties of the auction auctioning higher, for example. So an attempt to break, that does not happen. Because either aggressive sellers take control of the market, or because this phase of aggressive buying exhausts and aggressive selling starts to take control again and brings price back in a situation of fair value and the auction in a situation of balance. This is what we call a failed auction. Could happen on the other side, right? All of these buyers are considering these prices to be fair enough to push price higher. And if sellers do the same thing and they try and auction lower, well, you could expect the same buyers that bought here, well, now they're going to consider these prices even cheaper. So you're going to have some form of pressure that will lead prices back up in a situation of balance. So this attempt of one party to search for lower liquidity that fails, to try a new price discovery phase that fails, we call failed auction. And it can come in a bunch of different fashions. It could either be an exhaustion from sellers and buyers taking the upper hand again, or it could be sellers being absorbed, that they try to actually push, but they find a wall of passive buyers, and then they simply give up and buyers take the upper hand. So it can either be a dry up in sell volume while going down, or an absorption from buyers. Same thing over here, either a dry up in buy volume, or buy volume increasing but finding a wall. That, like Gandalf, right? You shall not pass. And then sellers taking the upper hand. Same thing over here, right? We had 2 times a failed auction. The sellers try to auction lower and accept paying lower prices. But the same buyers that considered this, and this is even more powerful, the same buyers that consider these prices to be completely fair, actually super cheap, driving the auction higher, causing a situation of imbalance, well, those ones now are going to be very hungry to buy more. And any attempt to exit the fair value has a higher likelihood of failing than creating a new auction, because you have this to deal with first. You have these prices to deal with first. And buyers were considering these super cheap in a very recent time. But at the same time, sellers might be ready to keep the buyers in check above here. Every time buyers try to attempt auctioning higher, these are prices that for sellers are considerably cheap, or in this case, a really good premium to sell. And they will push price back into balance. This is what will happen most of the time. Price will attempt to break out. There's only one breakout that works. Only one actually breaks out, because it breaks out. These ones are attempt to break out, that simply breaks back in. And we call these failed auctions. So you will tend to see areas of balance, areas of imbalance that will coincide with areas of fair valuation from the perspective of volume, low volume areas, and then high volume areas again. Just like this. Areas where market agreed on a price, stayed there a bunch of time, and traded a lot of money. Areas where not a lot of volume was traded, not a lot of money was traded, not a lot of time was spent there, but the auction was way more aggressive. So still very significant. These, by the way, are the best, absolute best trading setups, because you both get the strength of the imbalance, the exit from fair value, and a situation where buyers are also keeping the sellers in check in a situation of fair value. And sellers likely considering these prices a little more fair than these ones. So in a situation like this, when we'd like to take a look at price action, we'll not just draw highs and lows as visual reference points, because this is Dow theory, right? Market is high, market is low, market is going high, market is going low, so higher high, higher low, we're in uptrend, good boy. Yeah. We'll take a look at the market in this way. Where's the most volume traded? Where did the price try to auction? And what happened after? What was the effort? What was the result? This is a much more rational way of looking at markets, because it's based on facts, it's based on data, it's based on volume. Hi, and welcome back to the Auction Market Theory 102. We're going to discuss now trading ranges in failed auctions. So whenever price approaches the extremes of our fair valuation area, where statistically 70%, which is a standard deviation, of volume is traded, of money is exchanged, of trading activity is happening, we get into the anomalies. Okay? With the same principle we've decided and decoded before. These are the areas where we either want to sell at as soon as price approaches them, when we see confirmation from order flow, or wait to be broken and see an attempt of an upside auction failing, which is even better. Okay. Same thing over here. When this happens, or when this happens, those are potential high probability buying opportunities. So we want to then take a look at what happens with order flow inside of these areas to find a confirmation that passive and aggressive forces are giving us a asymmetric opportunity from a risk to reward and win rate standpoint. So we want a high probability of going up and a high risk to reward for taking that trade. So these are very simple models, very simple models. We take a daily volume profile and we look at what happens here, what happens here. We wait for a confirmation that price will drop back inside, and we take that trade to the other side, and vice versa. Now let's make an example, a practical example, by looking at a situation of clear fair value and looking at what happens in the following session. Well, we know these are the areas, so let's remove the volume profile so we can just see the price action and the order flow. The next session starts here. So we already have a good indication. We started our session inside of the previous value area. Then what happens? Take a look at order flow and we read what might have happened. Well, the first idea, as we said, is we're going to try and see if there's any buy opportunity here, right? So we see price dropping, dropping, dropping. And at some point here, we see a lot of volume traded from both sides. So we have a war here between buyers and sellers, which we could consider some form of absorption. And when we try to auction lower, what happens? There's a dry up in volume. There's some selling, but buyers are way more aggressive. Well, that's a failed auction right here. We have a big phase of absorption. So we probably price did something like this, tried to push out, then was dropped back inside by aggressive buyers. So we have a failed auction. And then price pushing high really aggressively. A lot of imbalances on the side. That's when we know where we have, let's say, the first indication that price is likely to bounce back off. Can take volume itself. So there was a lot of volume in this candle, but no follow through. And the following candle dropped back inside. And from here, this is our buy idea to the other side of the range. You could either wait for a test or wait for the following candle to close and even maybe take a slightly lower risk to reward. 1 to 2. And that's a high probability trade. Now let's go to the other side and see what happens. Well, we have buyers really aggressive on the upside. As soon as we're outside, big volume dropping back inside. But the candle still does not close back inside. More aggressive buying is being absorbed here. And as we stay outside of here, volume dries up. So there's a phase of exhaustion. There's not a lot of trading activity here. And then what happens? Well, we drop aggressively back inside with even more volume and a lot of aggression, a lot of imbalances. Well, that's the first indication that we might continue lower. So we either wait for a test here, or for example do this and sell. In this one we likely get stopped out. But we took a good decision. We took a smart decision. The point here is not, making money all the time. The point here is looking at what's happening in the auction and acting accordingly. And then once again, what happens? We tried to drop back inside. We saw there was a lot of aggressive selling going on, but maybe they were not ready yet. So buyers take the upper hand again while being inside of the range. They push price outside, and as they do, volume again dries up. Aggressive selling, pump in volume. And the last candle that tells us buyers are not ready is here, where we see again an exhaustion in buyers that tries to push up very quickly. They go down, and the following candle is just unrefutable proof that we're ready to drop back inside. Look at this. Super high delta imbalances, super high volume, drops back inside, tests, and that's our entry. And slowly but surely, that's what happens. So with this very simple framework, we took one trade, take profit, we took another trade, stop loss, and took the last trade, take profit. With a very easy framework, looking at what buyers are doing, look at what sellers are doing, framing the auction correctly, so we have a context of what we want to do, and we take the decision based on data. We take the decision based on what the money is telling us. Hi and welcome to Auction Market Theory 103, Trading Breakouts. So we talked about how to behave in a ranging type of situation. But let's also identify what happens when we break out of certain volume areas. So we might be in an uptrend already, and we might want to join the trend instead of opting for a ping-pong reversal. So we want to take a look at what happens here, for example. We want to take a look at what happens during the test with order flow. And framing our entry for a breakout in a directional session, while at the same time seeing what happens during the breakout through order flow and see if there's a high chance, a high likelihood of a follow through in price. So what we would like to see in a situation like this is high volume, high delta, and not something that simply dries up. Something that continues to have a high volume. And if and when there is an attempt for sellers to drop back inside of a comfortable area, we want to see a dry up in sell volume and buyers taking the upper hand on the test as well. Then we know it's a valid breakout. And we can take the same example we've had here. We have a situation where price tried to auction higher but couldn't. So we finally have a break below with a lot of candles closing below. And what can we see if we look at order flow? Can we see during the breakout an increase in volume that does not stop? Well, this is the candle that broke out. Let's look at volume. Oh, look at that. Increasingly high, and then increasingly high again. Well, how about on the buy side? Is there increasing volume? Not so much. Oh, that's a very interesting thing. That's exactly the polar opposite of what happened here, where we had at the breakout buy volume drying up, and then when we dropped back inside, then volume rising up again. This is exactly the opposite. And it's data. It's undisputable proof. It's data based on money. Well, this candle is not just a fat ass candle, but a lot of imbalances. Okay. Interesting. Sellers being absorbed slightly at the bottom, but then poked through. Okay, we have all the confirmations that this is a qualified breakout. Again, little fair valuation, again, fair valuation, and then auctioning lower and lower. Also, the small time fractal volume profiles tells us that value is going lower. Then we have a retracement. We have an auction higher. Okay, well, our bias is sell, right? It's pretty clear. This is the area we've been following through the whole time. Well, what happens here? What happens to all of these aggressive buyers? Oh, would you look at that? Absorbed, 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 absorbed. They try to push up, but they can't. And if they try harder, look at this imbalances on the top. Aggressive sellers take the upper hand again. And boom. Sellers take the upper hand. And what happens during the breakout? Volume increases again. One more test, and we melt for the entire session. Okay, there's probably a bug in the data feed. But all of that session with a qualified breakout where the money was telling us, not just a candle. Just looking at this, you're blind. You're just blind to what the market is actually able to tell you. And that's a breakout that we can trade very successfully. Either directly on the test, because we saw the volume here, we saw the volume going up, we saw the aggressions and buyers trying to absorb but failing, so we know who's in control in the auction. There's a lot of money in control of the auction, and it's going down. So whenever there's a pullback, that's an opportunity. So you either place yourself in the imbalance itself, which is a really good trick. So you basically look at the candle, take the cluster of imbalances, and that's your sell entry zone with a stop above the candle. Or if you want to be more conservative, you wait for a second confirmation, because you might be scared of this candle. You might say, hey, there's a lot of aggressive here. Let me see first. Well, totally fine. So you wait for a phase of absorption, sellers taking the upper hand again, buyers trying to stop them, failing. Okay, now it's the time. Stop above here. Let's fucking roll. And that's how you manage a breakout. Hi, and welcome to Order Flow Dynamics 101. We're going to take a look at how we can identify the auctions fractaling inside of the footprints, so auction footprints. We mainly divide the auctions in the footprint in initiative and responsive. Initiative being the same as a situation of imbalance. Responsive, similarly to what happens in a situation of balance. So what you would typically see during an initiative candle, so this is an initiative candle, these are both initiative candles, a sell initiative candle and a buy initiative candle, is you will see high volume, high delta percentage, because you want to see mostly aggressive buying or mostly aggressive selling going on inside of the candle and leading the auction higher or lower. You'll tend to want to see many imbalances, widespread volume distribution, so not just one big volume distribution, but you want to see it's widespread throughout the whole candle, just like this. and you want, of course, a full candle. So by high volume, you want to compare it, of course, to the previous candles. So you look at the previous candles, see if this one has more volume. With high delta percentage, you want to at least have more than 10% delta. There was a mistake here. Probably this was not percentage, but probably this would have been 2.2 divided by 5. That's around a quarter, so 25% delta ish, something less, maybe 20%. Well, that's a big delta. Whatever is above 10% is a decently good delta. So that's how we want to spot, even in the lower time frame, an initiative auction. So let's take here, for example, let's take a situation where we have a situation of ranging and then a breakout. Well, this one is clearly one. We have a situation of balance, right? And when we break out, what happens? Let's look at the candles and the order flow. Well, we see a lot of imbalance here, but we're still in the range, right? Let's first take a look at what's the actual range. Well, this is more or less the big range, right? And then we break out around here. So let's take a look at what happens during the actual breakout. Oh, there you go. Look at this. So we have first, of course, a buyer trying to absorb that gets completely ran through. And this candle tells us everything we need. We have a lot of imbalances. 1, 2, 3, 4, 5, 6 imbalances. We have an increase in volume activity. We have a really high delta, 37%. That's an initiative auction. The following great sell candle, what does it have? A lot of contracts, a lot of delta, maybe 7%, but still a lot of imbalances in the candles. That's what we want to see and what we tend to see during breakouts. Even here, below this low, we break down. What happens? Well, in the breakout, volume increases from 2.7 to 3.8. Again, prices break from a low, volume increases. And these are all initiative candles. Minus 11%, delta, and so on and so forth. So these are initiative auctions. High volume, high delta, many imbalances, big candles. A responsive auction, which is kind of the opposite, will tend to look something like this. You will tend to see during the ranging phase, in the upper ends, buyers being absorbed. So you'll see a lot of greens at the tops. A lot of greens at the top, green at the top, greens at the top. Especially if you're in this situation and you expect this. And right after, big imbalances and initiation coming as soon as we break through. So you want to see typically some phases of absorption at the top. And typically, if, for example, you're expecting an uptrend, you want to see also some at the bottoms. Okay, you want to see sellers being absorbed at the bottom, which didn't happen in this specific example. In this one, though, yes. We had aggression here, we have these imbalances, and as soon as we get too low, we start absorbing them. Purple on the bottom, and then aggressive buyers taking the upper hand. Responsiveness. So we have a response from passive buyers. Okay. So let's zoom in, let's see what happened here. And you can clearly see after a big directional phase, we have a situation of responsiveness. We have buyers absorbing all throughout the lows of the candles. You see the dark areas at the bottoms of the candles, right? This is clear responsiveness. This means that all of the passive buyers in these fascias of price are responding, are buying, are blocking the way. But then you look at the tops. You see a lot of green at the top, a lot of green at the top, a lot of green at the top. Well, also buyers are doing their thing. So this is our range. And as soon as we break out, we want to see some initiative. 23%, 1.4K, increase in volume. And what you would tend to see during these phases is delta tending to be flatter. Not a lot of high delta. You don't want to see a lot of high delta in these situations. It's likely less, okay? Likely a little bit less. And this is what you'll typically see in a situation of responsive auction. And these are the two types of auctions seen from the footprint chart. Hi and welcome back to Order Flow Mastery. This is Order Flow Dynamics 102, absorption versus exhaustion. And these are two, let's say, reversal type of patterns that are anticipating in a way the same thing, which is a reversal in price, but are fundamentally different. And we're going to see some example now. So we define an absorption as a lot of activity, in this case buying, that does not have a clear result in price. So you see these big ass volume areas, a lot of color, a lot of imbalance. That's called an absorption. A lot of money, a lot of volume clogged in a single tick, or in maybe 2 or 3 ticks. Same thing happened over here to sellers, by the way. When they tried to push down, sellers here were absorbed. 1,000 of them was absorbed here, but then they had a follow through, right? But these are called areas of absorption. An exhaustion phase instead is a phase where you'll typically see from a profile standpoint a dry up in volume. You see how there's less and less volume. And especially in the last few steps, there's less and less and less and less volume. So you don't have a clear phase of absorption here. You had an attempt, a dry up in sell volume, and buyers taking the upper hand right away. Not by absorbing, but with an exhaustion from sellers. So sellers stopped accepting lower prices at the same pace as buyers. Aggressive buyers. That's an exhaustion. That's the difference between a phase of absorption where you have the passive participants blocking price. Let's see if we can get back to this one. So here you have passive participants, passive sellers blocking price from going up and then taking the upper hand. That's absorption. When this happens in a way that it is aggressive selling that dries up without a clear wall from passive buyers, and then buyers taking the upper hand, that's what we define as an exhaustion. Slight difference, but very important to understand the language of order flow. This is two at the same time. This is a very common rejection pattern where you will see a high ratio order flow exhaustion. So the first thing you will see is on the sell side, so where we're coming from, what you want to see as a form of exhaustion, you want to see this number and this number having a higher ratio than 10 to 1. In this case, we have it. This is a high ratio order flow exhaustion. So there's an exhaustion in selling activity. And paired with this, you want to see an imbalance reversal. So on the very last auction, so with the 0 here, the first number here having an imbalance of at least 400% or 300%. You know, these are just numbers, but you want to see a big imbalance. This is a clear sign of rejection of both dry up in sell activity and huge strength from buyers. So you have a high ratio order flow exhaustion and an imbalance reversals, an imbalance on bottom. Same thing, by the way, happens the other way around. So you want to have a high ratio order flow exhaustion on the upside. So all of these aggressive buyers from 200 to 7. So it has at least a 10-to-1 ratio. And you want to see an imbalance on top. Okay, I forgot to write this. This should be imbalance rejection. Okay, same thing. So we have both buyers not willing to accept higher prices anymore, dry up in buying volume, and aggressive sellers taking the upper hand. When you see this at the top of a candle, it's a very good sign. It's a really, really good sign that will reject. Now, let's take another look at another very important pattern. And just as much as the stop run is an anomaly, also big orders are typically an anomaly. We want to capitalize on order flow anomalies that can reliably make us money. So big orders and iceberg walls are definitely one of them. Big orders are much more common than iceberg walls. Iceberg walls are way more rare. They used to be much more common in the markets, but they're worth mentioning because sometimes they'll happen in low liquidity environments, and that's a feast. So the first thing we want to see when we see absorptions in big orders is, for example, in a 1-minute candle in the ES, we want to see at least 1,000 contracts. Okay, that's our minimum threshold. We want to see a lot of green or a lot of purple based on the delta. And in these situations, if there's a huge order in the wick of the candle and price rejects from it, we know that that big market participant is dominating the market. If price were to do that and then break, we know there's something even bigger that's going to push price up. So whenever we have a huge trade above 1.2K contracts in an ES tick, 1-minute candle, and a rejection, that's a good indication that we could continue to go lower. If we have a closure of the candle above this, then we could keep going up. And here is a very clear example of the same thing. We closed a candle below and we started auctioning lower, and for that session, spoiler alert, we went down the whole freaking session. Same thing over here. So we want to take a look at the footprint. We see that there's an anomaly here, right? We have 1.2 thousand contracts in a single tick. That's a big order. That's either a big order in the book or an iceberg. You can discriminate if it's an iceberg or just a big trade by looking at the depth of market. And in the depth of market, what you will see here is a big order, right? In the DOM, in the aggressive, the passive buyers. That's how you know it's just a big order. Otherwise, you will not see it at all, and then you know it's an iceberg, which means it's a small order that's simply reloaded a bunch of times. And as you can see here, we don't candle close below this. We don't manage to close. The following candle is an upward candle, and we push up. Here we have another example shortly after of a passive buyer trying to block the upward auction of sellers, completely ran through, no candle close, and we keep auctioning higher. So you take these reference points of big trades and you see what does price do after. Well, that's a good indication of where price will likely keep going. But sometimes you might see situations like this. You're not going to find a lot of them, guys, but if you find them, well, if I find them, I will take advantage of them. It's not financial advice. But you can clearly see here that sellers are trying to go down, and there's a big buyer here, 260, and what happens? Bounce. We drop back down, bounce, drop back into it, bounce, drop back into it again, bounce. This is an edge you can capitalize on. This is called an iceberg wall. Okay, they're literally punching to the wall, and nothing moves. So this is a very big order, that we can front run and buy from, earn a couple ticks, wait for it to come again, so take profit, buy again, take profit, buy again, take profit, buy again, take profit a couple times, and then 90% of the time it will be ran through, and we can opt for a breakout trade. They will do something called momentum ignition. You will see a bunch of market order being shot into the market all at once, sort of like a stop run, and that's potentially a good entry for a sell. And that's how we trade big orders and iceberg walls. Here you have another example where there was a big order here, caused a bounce, and then price just ran through it like it was nothing. Momentum ignition, a lot of imbalances, market orders. That's a good sell setup. This is all scalping dynamics, by the way. And we dropped down for the rest of the entire session. But we had a big fight. Who won the big fight? Aggressive sellers. Well, that's where I'm joining the party. I want to stay with the winners. And I can clearly see, thanks to order flow, unlike with any other price action chart, what the big money, the smart money is doing. This is another example where we have a big trade over here. Candle closes below. We test it. We don't manage to have any auction above here, and we keep dropping for the entire session. This is another example where we had a very aggressive auction, a lot of imbalance, a lot of green going on. And then you had absorption here, absorption here, absorption here. These are all big orders. And they form this sort of liquidity pocket, this area where there's a lot of trading going on. Absorption on both sides of the auction. And in this type of situation, you see it's the same, exactly the same level. This is disturbingly accurate. But at the end of the day, what happens? We auction higher. Well, now we know where to go. Now we have a clear direction. We have a clear understanding of which one of these big fishes have won. Because it's not retails. It's not phytoplanktons. These are whales putting billions in the market every single minute of every single day. And we have undisputable proof of who has won that battle. And we want to be on the right side of that battle. Another example here. Big order, big absorption. Is there any candle at all that closes above here? No. What happens right after? Sell initiative, imbalances. Okay, you know what? Guess what I'm going to do when price comes and test it? One way out. Pure objectivity, pure raw data. Hi and welcome to Order Flow Dynamics 104 in this Order Flow Mastery course. In this video, we'll take a look at stop runs. And stop runs are a very interesting pattern in order flow that does not happen very often as much as people think. Okay. and they are much more insignificant than a lot of people think. Because a lot of people think that there's this stop loss hunting for retail traders, but retail traders make up probably less than 5% of the volume. Depends on the market, but they're not hunting for your stupid stop loss. Okay, that's just a fact. But sometimes stops might get triggered, and they may cause some price movement. Okay, I'm just saying that they're not hunting for them. Okay, no one is hunting for you. No one's after you. Okay, market don't give a shit about you. But above high and below lows, of course, there's stop orders, right? Because people place their stops above there, or their market orders for continuations, for example, sell stops below there. That's absolutely an observable phenomenon. So you will see stop runs. You will see moments where stop orders enter the market and move price. So let's say, for example, you have a high or multiple highs at the same time, and you would expect here to have stop orders. And stop orders, as we've discussed, are market orders. So they are aggressive buyers. Because if price is here, right? Let's say price is here. Okay. Let's change the color. Let's say price is here. What will you have? You will have passive buyers, and you will have passive sellers, right? So a buy stop that could be above there is placed above the current price, right? This is the current price. So it's a pending order that does not stay in the book, because in the book you have buy limits below the price and sell limits above the price. Above the price you have sellers in the book. So you will not see buy stops in the book. Buy stops will be placed there and executed, mark it, and take the best bid or the best ask. Okay? So let's say now price moves here and we approach this level, and there's a lot of buy stops here, right? Let's say this is buy stop, buy stop, buy stop, ready to enter the market. You have passive buyers here, and then you have passive sellers here. Well, all of these market buy orders, they will enter market, just like they're market orders, just buy market. So they go a little bit here, a little bit here, a little bit here, and they'll enter all at once in a very fast way, in a very fast-paced way, because they happen all at the same time. They're all triggered at the same time. And they will eat all of the liquidity in the book. They will eat all of these sellers, all these passive sellers, causing a very fast price move up that likely will get reabsorbed, because that's the path of this resistance. Because imagine all of these get bought. So these get bought, these get bought, these get bought. They're executed. So a lot of aggressive buying coming in. And let's say this is now price. Well, it's going to take some time for buyers to repopulate these levels with new passive orders. You're going to still have a lot of passive sellers above here. So now the path of least resistance is this one. Because in this situation, you'll typically not have a lot of orders here, because all of these aggressive buyers have swept the book. That's why we call it book sweeping. Not because the stops are being swept, but because the limit sell orders have been swept by market aggressors in the form of stop orders. So this will be an empty space in the book that will likely get filled right away. And then you see this happening. And a lot of traders will say, they hunted for my stop loss because they actually wanted to go down. Yeah, that's not how it works, bro. That's not how it fucking works. There's orders that have triggered a fast price movement. That's why we call it a run, because it's fast. It's very fast. And it will go down, not because there was a secret plan from the banks to fuck you up, but because there's way less liquidity here, and the path of least resistance is that one. Okay? That's all there is. No conspiracy theory, pure order flow. So what you would typically see in the first stages is all of these market orders entering the market, right? So this is an example of a stop run, and you'll see a lot of green in the candle. A lot of green. And 0, 0, 0, 0, 0. Why does that happen? Because all of these market order that maybe were above here are entering market all at once. So they're going to sweep all the book, and sellers will not even have the time to auction. Market makers are losing money here, okay, for a very short period of time. And so you will have a big ass pump up that 70, if not 90% of the time will reverse. Will reverse at least back to the book void, to the path of least resistance. That's a trade that that's a type of trade of setup that I've shared also on my YouTube channel. It went very popular. One of the last videos where I basically sell above here and basically opt for a reabsorption of price. This is another example. We have a stop run advanced indicator that basically you can set for the London session. This is a low liquidity pattern, by the way. This is very low liquidity pattern. It only works in low liquidity environments. So for example, what you want to see is high volume, high delta. So from 278 contracts to 4,000, mostly delta. Typically you want to see it above 20%. Because it's mostly buy orders, buy aggressors. Same thing over here. We have a very high delta. We get some stop, resting above here that swept the book. A lot of green in the candle, high volume, high delta, imbalances, big volume than the rest. We sell, we take the reabsorption, and that's it. Hi and welcome back to this order flow course. In this section, we'll take a look at session dynamics and understand the flow and the rhythm of the order flow throughout every single day. Starting by saying that there we have two main sessions, which is the extended or electronic trading hours and the regular trading hours. And they are two radically different sessions that you can simply spot if you have a normal chart from volume. Because you'll see you're going to have a lot of volume in this session and then basically zero. And then a lot of volume and then not a lot of volume. And then a lot of volume. That is because the official bell of the American stock market and of the CME starts at 9:30 local time, 3:30 Central European time, and ends at 4 p.m. local time, 10 p.m. Central European time. And that's our regular trading hours session, also known as cash session, because that's where most of the money is traded, where most of the big movement comes, where most of the smart money trades. In the meantime, though, some movement might happen, where you have the Asian session, the London session with slightly more volume and activity, and then again, American market session. And the way order flow behaves in these type of sessions and in the extended trading hours is radically different. Order flow anomalies will work way better during these times of day, because if there's a big fish, he's going to be one of the few ones in these sessions. Here, you'll have to read into the war of a lot of big fishes, of whales and sharks, and everyone is there joining the party, HFTs, all sorts of traders, much more volume, much more money, much more data to take into consideration. Here, you're going to have a lot of silence for a long time. But when you see a big trader, you just see it. It's just obvious. Okay? And that's the main difference between the regular trading hour and the extended trading hours. Hi, and welcome to Session Dynamics 102, opening and closing auction. An important part of the rhythm of the money flow is the first part of the session and the last part of the session. And what you will see, if you look at a normal volume chart, you'll see a lot of volume at the beginning, then drying up, maybe some spikes here and there in the middle, typically doing breakouts or doing V reversals. And then at the end, the very peak of volume. And that happens because before market opens, traders of all sizes and all sorts can send the exchange something called market on open orders. So orders that will be executed by the exchange in the first few minutes of the market auction. And you will typically have released in financialjuice.com, which is a free website for looking at news. This is a data that, you can, it's provided directly by the exchanges. You will have a market on open imbalance. That, for example, in this case was bearish. And as you can see, the first candle, the first volume was with a very purple delta. So the market on open imbalance tells us, is there an imbalance between buying and selling, either aggressive or passive? And how much is that? Throughout the session, then, market participants of all sorts will try to fill all of their orders, but they might not be able to fill all of them. So the orders that they were not able to fill throughout the sessions will enter the market at the end of the session on the form of market on close orders. And the exchange will release a market on close imbalance. An imbalance between buyers and sellers of market on close orders. And even here you can see on the S&P 500 we have minus 92 million. It's not much. We normally see way more. And you had a purple clear selling delta type of volume. And that's where most, the single biggest volume candle happens in every single session. Okay, this is another session. It's exactly the same. A little more at the beginning, pretty stable throughout the first part of the session, low in the middle, then typically higher volume in the so-called power hour. So the last, let's say, next few hours of the session, and then the big boom of volume, which is normally completely absorbed, by the way. It normally does not very often cause big price movement in the last 5 minutes of the session because it's just a settlement type of order flow, and it's mostly, filled mostly at the same price, so that you're not going to see a lot of movement typically in these parts of the session. But let's take an example. Let's take a look. Let's take directly a look. And if you zoom out with this type of template, you can also see in a different way that this is the extended trading hours, and this is the regular trading hours. More volume, more color, more delta, more color. And at the market on open, you will have a lot of volume, a lot of trading activity, a lot of absorptions going on here and there, a lot of darkness, a lot of delta, and big price swings. Not always, but very often. Then we wait until the end of the session. We go to the end. And here you see we get close to the closing of the session and you see most of the volume being traded. The highest concentration of volume in few candles. And you'll see a lot of 1K, 2K, 1K, a lot of volumes in the last part of the cash session, a lot of absorption. There's a feast of market makers right at the end of the session because they know there's a lot of orders, so they provide liquidity. And the candle of 21:59 European time, 3:59 local time will typically have a lot of contracts, the biggest one. 44,000 contracts in a single candle. Okay, and that's the closing auction. That's what happens because all of these market on close orders are entering the market. This is a very important thing you need to know about the auctions in indices and in most futures trading at the CME. Hi and welcome back to Order Flow Mastery course by Deep Charts, Session Dynamics 103. We're going to take a look at the typical daily auctions. So how does a session typically forms out? You can distinguish between clear directional sessions. So you're going to see a lot of session that starts directional and just keep going for the entire session and then find a balance. This one is an example. Okay. And that's what you're typically going to see. If in the first part of the session, there's a big amount of price variation, most of the average daily range, ADR or ATR, average true range, which is, let's say, the average excursion of price in a single session, which we could say maybe for stock, an average for the stock market, for the S&P 500, and an average session might go 1% up or 1% down, very rough estimate. Well, if in the first part of the session we already did plus 0.9%, we went up almost 1% in the first part of the session, there's a higher chance that after all of this aggressive buying, we'll find finally a situation of balance, okay? And this is typically what happens. If most of the movement happened in the first part of the day, you're going to see less volatility in the power hour and most likely consolidation at the end of the session, which if you are trading momentum or you're trading breakouts might not be the optimal scenario for you. Then you're going to find situations where you have market starting from a situation of balance, okay, and then pumping up. And you'll see high volume during the breakout, maybe a pullback. That's a great idea. And if you want to take a breakout trade, this is a good idea. If you want to trade it here, well, we have a high potential for volatility throughout that day, and then maybe closing once at least 50 to 60% of the ATR have been fulfilled, just like here, right? Like this, range, breakout test, likely a lot of volume here, awesome. We trade, and as soon as we see some consolidation, we get the fuck out, and that's our trade. Another type of session that is often common is a V reversal session. A session where it begins with a very directional auction, typically sell, but could be also a buy side auction, and then a V reversal. So not a lot of this, very directional day, but a very volatile day where price swings can also be very deep and retracements can be very deep. For example, here we opened down and then we moved up for the entire session and then we closed here. And in these types of situation, you might opt, if you're a breakout trader and you simply break out, those days could be a little bit annoying for you. If you are a reversal trader that, for example, here there's a big value area zone, and price opened here, so maybe the last session closed here, so you might expect a gap fill, and so you wait for this and then maybe buy it back. That can be a good scenario for you. Other sessions, and these are my least favorite, is the entirety of the session goes fully sideways. This doesn't happen very often, but when it happens, it's very annoying especially for breakout traders. For range bound trader, this is like the best day ever, right? Because here you can trade failed auctions all day long, literally all day long. And in these type of sessions, during the power hour, so let's say after, 1 p.m. local time or 7 p.m. Central European time, that's when you get all of the directional flow. And maybe you just wait all of the day for a breakout that does not happen. And if you constantly try and trade the breakout, you get stopped. And maybe you give up, your trades for the day are gone, and then market eventually goes. That can be annoying for breakout traders. But all of these sessions are common. All of these sessions are very likely to happen. But it's a very clear framework to understand what type of session we might be in today. Hi, and welcome back to Order Flow Mastery Session Dynamics 104. In this lesson, we'll take a look at the initial balance breakout, which is one of the highest performing historically price action, let's say, patterns, or let's say statistically valid edge in the markets. And the initial balance breakout is something very simple. It basically takes the first 15 minutes or 30 minutes or 60 minutes of the session. It takes that range or that candle, plots the high, plots the low, and whenever there's a candle breaking out from that at the lower time frame, for example 5-minute time frame, you buy or you sell. This is a very, I would say not very, but decently old strategy invented in the 1990s that has demonstrated to have a very consistent edge throughout decades. Okay, this is one example. This is a 5-minute chart, so you count 1. This is the first candle. 2, 3. These are your 15 minutes. You take the high, you take the low, and you trade the breakout, and that's a good trade. And this is the performance of a opening range breakout strategy, risking 2% per trade, compared to the performance of just buying and holding the S&P 500, started from 2021 till more or less today. And you can see that it has a better Sharpe ratio, a smoother equity line, and a clear edge, especially in times of very directional markets. In periods where maybe market are not that directional, then this might suffer. And you could have, entire years where the performance is not great. This is a long-term perspective, okay? So this is just a bias, right? More or less 70% of the time when there's an opening range breakout, you have some level of excursion, okay? It's not 100%, guys. It's not 100%. So if you're going to use this type of model that then Fabio has put on steroids with the IVB model, which is the initial volume breakout that he will explain to you, and that is available in the Deep Charts full version, don't expect a 100% win rate. There can be long periods of time where you don't see a lot of profit. That's completely normal, because that's, a different type. This is a very mechanical edge, right? But with the right context, with volume analysis, with order flow, you can qualify breakouts in a way that just by looking at candles, you simply can't. Because the money will tell us if that breakout will hold or not. But it's an edge that has a consistency, a very mechanical base, because it's a very easy strategy. It's no big deal, but that you can build on top of that your discretional narrative thanks to real order flow data. So let's take the last session as an example. So the first 15 minutes, we had, this is the low, and this 45, this as the high of the opening range. So this is our opening range. And what you want to see is a breakout above, and the breakout happens. Let's put ourselves in the 5-minute time frame just to have. So I'm going to load my favorite 5-minute template. So for example, we take a look at what the volume does above here in the 5 minutes. And we might see that there's a lot of aggressive selling that is completely and utterly absorbed. So there's a lot of volume, right? Volume is increasing. There's a lot of volume activity, which means interest, which means participation, which means the smart money is there. But look at what happened. Yeah, it's all purple, but why? Because look at this, all of this absorption of sellers. Sellers trying to go here, but they were completely absorbed from buyers. So buyers are more active on the passive side. They completely absorb all sorts of seller, and that's a very clear indication that this breakout is very likely going to continue. And there you go. Again, also here, absorption at the bottoms, exhaustion, big imbalance. Again, at the top, a lot of sellers. What happens to them? They're all absorbed. This is the clearest you can get on market mechanics. And this is how you can take something very basic as a opening range breakout or an initial volume breakout, an initial balance, and thanks to volume, being able to take advantage of that with a very, very, very clear bias to begin with. Hi, and welcome back to the last session dynamics lesson, 105, RTH gap fill. And the RTH gap fill is nothing more than a gap between the closing price of the previous regular trading hour session or the cash session and the opening of the new one. If there is a gap between them, we have a 68% chance that it will get refilled. This is another structural edge of ES and NASDAQ, just like the opening range breakout. So these are very mechanical ideas, very mechanical edges, where you, on top of that, can build your discretionary narrative to get to know order flow a little bit better, but basing it on something very solid to begin with, to start building the right habits. So in a situation like this, you might, for example, see that here you have a very big volume area that we can likely bounce. We have a great deal of chance that we'll fill this up. So what I would do here is maybe either wait for a very big signal, or let's say good indication that buyers are in control, and either join the train on the way or wait for a new consolidation phase to happen and a breakout out of that. So fractally looking for an auction higher with, ranges, and wait for a breakout in the same fashion and stop below here, target here. Really easy trade. Really easy trade. You don't have to overcomplicate it. You can take a bias by looking at where we are in the volume profile. If we're inside and we want to ping pong, if we're breaking out and want to look at volume to continue, or you take the opening range breakout and look at what happens during the breakouts. If there's an initiative, if there's volume, if there's initiative, we continue. Or same thing, if this was the previous session and now the previous session opens here, the next session opened here, there's a gap, perfect. I'll try and sell it as soon as I see some aggressive selling kicking in and market auctioning lower and lower. These are 4 very simple ways to start implementing order flow analysis as a confirmation for your entries given a volume bias or a statistical bias. Also, this strategy, by the way, something similar to this, has a decent edge overall. So this is a structural edge again. But this one I would say needs a little bit more context. And let's try now. Something very easy you can do is click here and just delete and not have the extended trading hour section on chart. And you're basically going to find yourself with a chart that by itself just has the regular trading hours without having to, create a custom session and all of that stuff. So we're going to wait for this to load. Yep, and in this situation, it's very awesome because you had both edges at the same time. Let's take off the volume profile. You had both a gap to fill and an opening range breakout. I mean, that's just free money, as Fabio would say. You have all of the confirmations we talked about before, plus an opening range breakout, plus a gap fill. So you had your target preset. Absolutely phenomenal. So we break the opening range breakout, so we have a very high probability that we continue up, plus we have a gap that we have a very high probability of filling, plus the auction is on our favor and buyers are absorbing any sellers that tries to go lower. This is just like very, very high percentage win rate stuff. And you can just simply wait for a session like this. You wait for a session to gap down, you wait for an opening range to be broken up, you see if there's a lot of volume, and this is an extremely high probability setup, extremely high. And this is how you take order flow and contextualize it with an edge that is very, very solid. So this was the Order Flow Mastery course. We've been through all of the trading tools that Order Flow can provide, all of the market mechanics that goes around it, all of the auction market theory model that models the money flow. We've understood the rhythm of the money flow and some statistical edges based on the rhythm of the money flow, where we can then use auction dynamics, short-term auction dynamics in the footprint charts to time our entries with confidence.